Good afternoon, everyone, and thank you for joining us today for our session on when, where, and why, covering journal entries and due to and due from explained. My name is Bill Webb. I'm the Director of Operations here at CKH Group, and I lead our government accounting team. So I'll be your narrator for today's session, and you'll also be hearing from two of our featured speakers, Ms. Yvette Hasbrouck and Mr. Leo Frangis, whom I'll introduce in just a moment. Over the next hour, we're going to walk through two topics that sit at the heart of a clean, audit-ready set of government financials: the everyday journal entry and the often misunderstood world of interfund accounting, specifically due tos and due froms. This is a group internet session offered for 1 CPE credit. So before we dig in, I will cover a couple housekeeping items so that everyone knows what's needed to earn that credit. So first, we won't be holding a live question and answer today during the session. So we won't take any questions during the sessions or at the end. So if anything does come up as you go, you have a question, you want to follow up with us, feel free to drop it into the Q&A panel, and someone from our team will follow up with you after the presentation is over. So in order for you to earn your CPE credit today, there are 3 requirements. First, you'll need to attend at least 50 minutes of the session. Secondly, you'll need to answer all of the engagement polls, of which there are 3, and they'll pop up at natural breaks throughout the presentation. And then lastly, you will need to complete the follow-up assessment form that we will send to you once the presentation is complete. So of note, that evaluation form is of the course itself. It's not a test on the material or who your favorite presenter was. No quiz on the content and anything like that. So if anything happens during the presentation, if your answers aren't submitted for the polls, feel free to just submit it by email to us or drop it in the question and answer panel, and we'll make sure you get your credit. So now, a brief introduction, just a little bit about us. CKH Group is a small business CPA firm with offices in Atlanta, Georgia, and Hawkinsville, Georgia. We offer government contracting solutions across assurance, tax, advisory, and accounting. We work with agencies at the federal, state, and local government level. So we've been practicing for over 23 years, and our mission is pretty straightforward. Give communities and their financial leaders quality accounting support, and making that accessible to all of our clients. So to put some numbers behind that, we've served more than 80 government clients over the past 3 years, and have well over 40,000 hours of government accounting under our belt. So an introduction for our speakers today. First, Ms. Yvette Hasbrouck. She's one of our managers of business development, as well as one of our government accounting leads. Her background is in municipal government operations, payroll, and executive office management. And for Mr. Leo Frangis, he's also one of our lead accountants here. He has an MBA and works closely hand in hand with a lot of our municipal government clients. So between them, they bring exactly the type of hands-on experience this material calls for, and the content that you'll see today reflects that expertise. So quick overview of the agenda before we dive into the content. We're going to spend the first half of the session discussing journal entries, so what a journal entry actually is, when you'd reach for the different types, provide you some real examples where you'll see them ripple through your financials, and then best practices that keep them clean, ultimately why they matter. So then we'll shift from that to due tos and due froms and interfund accounting. So what is interfund accounting? The types of interfund activity, where that activity shows up in your statements, how due tos and due froms, how they actually work, this distinction between a transfer and a due to and due from, things of that nature. So we'll work several journal entry examples together, look at how to spot errors, how to see missing entries, and then close on some common mistakes and how to avoid those mistakes. So notice the theme that we've woven through both halves of the presentation, the when, where, and why. So when do you make the entry? Where does it land in your books? And then why does it matter? So with that, we're going to get started on journal entries. Yvette?
Hello, and thank you all for joining us today. My name is Yvette. I've been a part of the CKH team for 15 years this month, and I'm just one of many who work in the government accounting team here at CKH. During today's session, I'll cover the when, where, and whys of journal entries as it relates to the municipal space from our perspective as auditors. Municipal accounting is more than just balancing the books. It's ensuring transparency, accountability, and stewardship of public funds. Every journal entry contributes to that mission by creating an accurate, audible record of how public resources are managed. I always like to start off with a little giggle on my day, so I figured we'd start the class off the same way. I want you to take a look at these two images on screen. Do y'all notice how each of them seem like the jokes are missing something? So the first one that looks like a therapy session, it's missing the question, what did the crayon say to the pencil? I never get to fix my mistakes. And then the other one is missing the question as well. What did GPS say to the auditor? It said recalculating. I don't make errors, I make adjustments. Notice how GPS never says you made a mistake. With your journal entries, embrace the detours, adjust the course, and then keep moving forward. Sometimes the images that you see above is what our journal entries look like to the auditors. They're only telling one half of the story. Every journal entry should answer 3 questions. What happened? Why is it being corrected? And what accounts are impacted? In municipal accounting, posting a journal entry is like just half the job, but understanding when to use it, where it belongs, and why it matters is what keeps the books clean. Okay, now let's get for real. Let's take a moment and talk about what a journal entry is. In today's presentation, we're going to discuss journal entries and their role as formal accounting transactions used to record, correct, adjust, reclassify financial activity within your general ledger. One of the most common mistakes that we do see in municipal accounting is focusing solely on one side of the entry, usually the debit side, without fully considering the impact across the corresponding accounts, funds, or the financial statement. A journal entry is so much more than just debit and credit. It tells a financial story of a transaction and helps ensure that your records maintain accurate, transparent, and are audit ready. On the next slide, I want to walk through some key components of a well-prepared journal entry and discuss what every journal entry should look like and include before it's posted to the general ledger. Please keep in mind that in the examples that I use, we'll be presenting as if the year end is June 30. Every journal entry, of course, you guys know, is going to follow the basic accounting rule. Total debits equal total credits. If the debit and credits don't match, the entry is incomplete. A good journal entry is going to show everything that you see here on the screen. So let's start with the journal entry number. Now, I do know that all systems don't automatically provide a journal entry reference number. However, it is best practice to create a consistent sequential reference number format. And then we have the posting date. The posting date tells us when the journal entry affects the financial records and reporting period. This is my sidebar flag. Let's take a sidebar. The posting date matters because it determines the accounting period. By identifying the month or fiscal year in which the transaction will be recorded, and it controls period end reporting. So like a June 30 posting date affects the current fiscal year, where a July 1 posting date is going to affect the next fiscal year. So one thing that you can kind of remember is transaction date is when the activity occurred. Posting date is when the activity hits the books. Okay, back to the journal entry. Your account numbers. The account numbers tell us which accounts are being affected by the journal entry and how the transaction will be reported on your financial statement. Then we have the debits and credit. Of course, we're just going to follow the golden rule, debit equals credit. And then lastly, your description. This should be useful information about the transaction, preferably more than one word. On the next slide, I want to show you guys how we're going to utilize the different types of journal entries and what situations they'll best be used in. First up, we have reoccurring entries. These are entries that happen on a regular basis, such as monthly debt payments or payroll. Then we have accruals and deferrals. These help us record revenue and expenses in the proper accounting period. These are especially important at month end and year end close. Next, we have reclassifying entries. These are used when a transaction was recorded correctly, but it could be in the wrong account, wrong department, wrong project, or wrong fund. These entries help ensure accurate reporting. Then we have allocation entries. Allocation entries will distribute cost across departments, funds, or programs. A common example would be allocating administrative cost among multiple funds. Next, we have reversing journal entries. These are created to reverse a prior accrual or adjustment in the following accounting period. This prevents transactions from being recorded twice. The duplicate posting is always fun. Then we have adjusting entries. These are made to correct balances and ensure financial statements are accurate before reporting periods are closed. And now we have proposed audit adjustments. Don't you guys love those? These entries are identified during the audit process. Auditors may recommend these adjustments to ensure compliance with accounting standards and to improve the overall financial statement accuracy. And last but not least, we have opening and closing entries. These are used during fiscal year transactions. Your closing entries will help close out the current year, while the opening entries will establish the beginning balances for the next fiscal year. The important thing to remember about each type of journal entry is that they all have a specific purpose, but they all share the same common goal, ensuring that your financial records are complete, accurate, and audit ready. Remember, not all journal entries serve the same purpose. In government accounting, we use different types of journal entries depending on what we're trying to accomplish. I want to give you guys some examples of when you would use, a journal entry in real life, in your day-to-day. So we're going to take a look at 3 different types. The first example is an accrual journal entry. An accrual journal entry records what happened financially, even if the money hasn't moved. You can think of this as the accounting equivalent of writing an IOU. We receive the benefit, record the expense. We earn the revenue, record the revenue. The cash will catch up later. The example that you see here shows that your pay period ended on June 30th, which means the employees earned wages in the last week in June. However, payday is in July. Since the expense belongs to June, it must be recorded before your year end. So that's what that journal entry would look like. The next example is going to be a reclassification journal entry. With reclassifications, most of the time or sometimes the transaction itself is okay. It's just landed in the wrong place. This example shows that the expense was coded to capital outlay, but it should have been noted as repairs and maintenance. Something that I want you guys to also note about reclassifying entries is that a reclass entry moves activity without actually changing your overall financial impact. And this has happened, I would say, more times than none when multiple departments share a vendor or even when their staff changes. The last example that you'll see on screen is going to be year-end adjustments. These are entries that help prepare your books for audit and financial reporting. Now, there are a handful of accruals that often fall into the year-end adjustment bucket, along with the other usual suspects. The example that I use here is showing that our municipality paid a 1-year insurance premium in January. 6 months remain after our year end of June 30. So, by creating a journal entry, this will remove future period costs from the current year's expenses. As we approach year end, remember we're using June 30 as our example, there are a handful of adjustments that nearly every municipality will encounter. Understanding these adjustments can make the audit so much smoother and help to ensure that your financial statements are accurate. Let's take a look at the 5 common year-end adjustments. I'm sure you all have touched on these at least once or twice. The first one is going to be accrued payroll. This adjustment records payroll expenses that employees have earned but have not yet been paid. The goal here is to match the expense in the period in which the employees earned it. Next, we have accounts payable accruals. These are expenses that have been incurred but not yet paid or entered into the accounting system before year end. Example of this would be a legal fee, an audit fee, utility, or even vendor invoices that have been received after year end, but the services were provided before year end. The key question that you want to ask is, did we receive the goods or services before year end? If yes, your expense needs to be accrued. Then we have number 3, grants receivables. Many municipalities operate on reimbursement-based grants. If eligible expenditures have been incurred, but reimbursement has not yet been received, a grant receivable may need to be recorded. This ensures that grant revenue is recognized in the same period as the related expenditures. And then our favorite, due to and due from adjustments. These entries are used when one fund has paid an expense or received a resource on behalf of another fund. At year end, it's important to verify that all interfund balances are accurate, supported, and properly reconciled between funds. This is one of the most common areas reviewed by auditors. I know a guy, so I know that's true. Number 5, capital asset and depreciation entries. Capital asset adjustments ensure that your qualifying purchases are properly recorded as assets rather than expenses, and depreciation entries allocate the cost to those assets over their useful lives, as required for government-wide financial statements. These adjustments help to present a more complete picture of your long-term financial position. As you can see, all of these 5 adjustments have one thing in common. They help ensure that the financial activity is reported in the correct fiscal year and in the correct place. When you guys and all of us understand that these adjustments are important, if we address them before the audit begins, they reduce findings, they improve financial reporting, and they make year end significantly less stressful for everyone involved. Now we're going to move on to a poll. Time for a poll. So if you have trouble responding to the polls that we have, please submit your question and answer via email or on the Q&A so that you can make sure that you get the appropriate proof of engagement. This question is, how often do you use journal entries to record data? All the time, often, sometimes, rarely, or never. Okay. Anyone else want to respond? Okay, I'm going to keep going, but please respond. Right now, it looks like we have all of the time, which is good and perfect that you're in this class. Okay, I'm going to keep on moving. Next slide that I have here is we're going to talk about where your journal entries are impacting. What are they impacting? One journal entry can look so small on the screen. It's like a little box up in the corner, but it can ripple through your entire financial system. So I want to take a moment and touch on where your journal entries actually make an impact, just so that you know. The first stop is the GL, your general ledger. This is the master record of all financial activity. Every journal entry posts directly into the GL. This is like the municipality's financial history book. If the journal entry is wrong, the story in the GL is wrong too. 4 things you always want to remember before posting: the amount, the account number, the fund number, and the description. This will save you time and your peers. The next stop is the trial balance. Your TB is the checkpoint that tells us whether the books are mathematically balanced. The key point to remember is every journal entry changes the trial balance. Some examples: an increase in an expense, the TB changes. You move activity between funds, the TB changes. You record an accrual, guess what? The TB changes. The TB is like an accounting scoreboard. If something looks unusual, there's a good chance the journal entry caused it. One important reminder is that balance does not always mean correct. A journal entry can technically balance, but be posted to the wrong account or wrong fund, and therefore it is not correct. And then the last stop is your financial statement. These reports are impacted in your financial statement. The balance sheet, your income statement, your statement of revenues and expenditures. It could impact your fund statements and even your budget to actual reports. Our journal entries ultimately flow into the reports used by management, council, auditors, and the public. A single incorrect journal entry can affect decision-making, audits, and public reporting. That's why your documentation is so important. When auditors ask you a question, they're going to follow the trail back to the journal entry, even though they're asking you the question. So it's important to remember that our journal entries don't live in isolation. They impact the GL that flows to the TB that ultimately shape the financial statements that, people rely on from your community. So on the next slide, what we're going to do is go over some best practices for creating a journal entry. All right. So the first up, use clear descriptions. Explain the purpose of your entry. Include dates, departments, and supporting details. Try to avoid the one-word descriptions like adjustment or correction. Like a good example would be to adjust payroll expense and payroll liabilities for wages earned through June, but not paid until July. Another one could be to correct posting of office supplies, an office supply expense that was incorrectly charged to capital outlay during June. One thing to remember with your descriptions, adjustment means the transaction is missing or incomplete, like an accruing payroll, recording depreciation, or recognizing grant receivables. Correction is going to mean the transaction was recorded incorrectly. Wrong account, wrong fund, wrong department, wrong amount. Okay? So now attach your supporting documentation. This can look like many different things. It can look like an invoice, a payroll report, a grant reimbursement request, a spreadsheet, your scribbled calculation on a piece of paper, or an auditor schedule. What you want to know is one of the rules that we have here is that the auditor asks why your supporting documentation should answer the question. Next up is going to be review the debt that your debits equals your credits. Ensure that the entry balances. Confirm the correct fund and account numbers are being used. Then you want to review the impact on your budget. Consider whether the entry affects the budget to actual report. Verify if expenditures are charged to the proper department and the proper account. And most importantly, check your own work. Check for a duplicate entry. Review the impact of the entry and ask yourself, did this give me the result that I was looking for? Sometimes with all of the stuff that we have going on, we get the direction wrong. So just double check that information. And also what you want to do when you're checking your work is make sure that your entry matches the supporting document. And if your system allows it, scan it in. It's better to have the proof there than having to look into a file cabinet. Next up, we want to use proper approval procedures. Follow your internal controls policies. Significant entries should be reviewed by management. And you want to maintain segregation of duties at all times when possible. Most important one, I think is the most important one, is post your entries timely. Record corrections as soon as you identify the errors. Complete month-end and year-end adjustments promptly. And just avoid waiting until the audit to try to fix issues because other things are going to need your attention. And one of the most important things is never delete history. Reverse or correct entries rather than deleting them. You always want to maintain a clear audit trail. One thing that I've learned is that a good journal entry tells a complete story. A great journal entry tells the story so clear that the auditor never has to ask you about anything. Journal entries are powerful. They're one of the most powerful tools that we have in accounting, but they're also one of the easiest ways to create problems if used improperly. When you're making a journal entry, 3 questions should be asked. Why are we making this entry? What support do we have for it? And would someone unfamiliar with this transaction understand it 6 months from now? If you answered no to any of those, your journal entry needs some work. Journal entries oftentimes move money. So before we move the money, let's determine who owes who. So now that we've went over all of that wonderful information about the best practices, where your journal entries are affecting, let's look at what happens when a transaction involves more than one fund. Many of the journal entries that I just reviewed affect only a single fund. However, as you all know, in local government, it's very common for one fund to pay an expense on behalf of another fund, transfer resources, or just share costs across departments and operations. When that happens, we move into the wonderful world of interfund accounting. In fact, many of the due to and due from issues that auditors identify each year can be traced back to a journal entry, or it was coded wrong, or it was never recorded at all. So as we move into this next section, I want you guys to keep something in mind. I'm sorry, ladies and gentlemen, keep something in mind. Journal entries record the transaction. Interfund accounting records the relationship between the funds involved in that transaction. So now what I'm going to do is hand you all over to Leo, and he's going to give more details about when due to and due froms are appropriate and how interfund activity impacts your financial statements. Leo, take it away.
All right. Thank you, Yvette. And if you don't already know, my name is Leo Frangis, and I am an accountant here at CKH. So now that we've covered journal entries, we're going to build on that foundation and talk about one of the most common areas where journal entries are used in government accounting, which would be interfund activity and due to, due from accounting. If journal entries tell the story of what happened, due to and due from accounts help tell the story of who owes whom when multiple funds are involved. Most governments operate through several different funds, each with its own purpose, restrictions, and reporting requirements. Because those funds frequently interact with each other, we need a way to track those transactions while keeping each fund's records accurate and separate. Today we'll cover what interfund accounting is, when due to, due from accounts are appropriate, how interfund activity impacts the financial statements, and then we'll look at some common journal entries and some mistakes that we see most often during reconciliations and audits. So at its simplest, interfund accounting is the process of tracking financial activity between funds within the same government. Even though all of these funds belong to the same city or county, each fund has its own accounting records and often its own legal restrictions on how the resources can be used. Because of that, when one fund pays for something that belongs to another fund, or when resources move between funds, we need to properly record the activity in both places. So one important note is understanding the difference between interfund activity and intergovernmental activity. Interfund activity occurs between funds within the same government, while intergovernmental activity occurs between separate governments or organizations. One thing I want everyone to notice is the statement at the bottom of the slide. Every interfund transaction results in at least 2 journal entries. That's because every transaction affects at least 2 funds. This is one reason interfund activity becomes such a common source of reconciliation issues. If one side gets recorded and the other side doesn't, your due to, due from balances will never agree. So looking at interfund activity, it generally falls into two categories. You have reciprocal, and then you have non-reciprocal activity. Reciprocal activity occurs when there is an exchange between funds. One fund provides something of value, and another fund receives it. Examples include interfund loans and interfund services provided and used. An interfund loan occurs when one fund temporarily lends resources to another fund with repayment expected. Interfund services occur when one fund provides goods or services to another, such as a utility fund charging another department for water usage. So now let's look at non-reciprocal activity, which involves a permanent movement of resources where repayment is not expected. On the right side of the slide, you'll see transfers in and transfers out. These are simply the two sides of the same transfer transaction. For each, for example, the general fund may transfer resources to a debt service fund to make bond payments. The general fund will record a transfer out, while the debt service fund will record a transfer in. All right, everyone, time for a poll. So which type of interfund activity do you encounter most often? And remember, if you're having issues with the poll, please submit your answer and question via email or Q&A. All right, we'll give everyone a few more seconds, but it looks like right now, most people are answering with interfund transfers. All right. So moving on, so now that we've discussed the different types of interfund activity, let's talk about where that activity actually shows up in your accounting records and financial reports. One of the biggest misconceptions I encounter is the idea that interfund activity only affects the balance sheet. In reality, it impacts multiple reports that management, auditors, elected officials, and department heads rely on. So let's start looking at the balance sheet. Due to and due from activity directly affect the balance sheet because it creates assets and liabilities between funds. A due from account is reported as an asset because one fund expects to receive resources from another fund. A due to account is reported as a liability because repayment is owed to another fund. This is often where auditors begin their review because these balances should reconcile between funds. If one fund reports a due from balance, another fund should report a matching due to balance. Okay, so let's now look at the statement of activities. So interfund activity can affect revenues and expenditures depending on how transactions are recorded. For example, if an expense is charged to the wrong fund and never corrected, the statement of activities may be overstating expenditures in one fund while understating expenditures in another fund. The result is that financial reports no longer accurately reflect which fund actually benefits from the transaction. This is one reason proper interfund accounting is so important. It helps ensure revenues and expenditures are reported in the correct place. Okay, so now let's talk about the budget to actual report. This is often where municipalities first notice interfund problems. If a transaction is recorded in the wrong fund, your budget to actual report may show one department significantly over budget, while another department appears under budget. Management may begin asking questions about spending patterns when the real issue is simply that the interfund transaction was just not recorded correctly. So in other words, interfund accounting doesn't just impact your year-end financial statements. It can affect operational decision-making throughout the year. If those allocations are not recorded, budget reports, expenditure reports, and fund balances all may be misstated. One way I like to think about this is interfund accounting affects who owns the cash, who incurred the expense, and who ultimately owes the money. If any of those pieces are incorrect, your financial reports may not tell a complete story. So that is why it is important to review interfund activity regularly and not just wait until the year end or audit fieldwork to identify issues. So now let's talk a little bit more about due to and due from. So you can think of due to and due from accounts as internal IOUs between funds. They allow governments to keep funds legally separate while still accounting for situations where one fund temporarily covers costs for another. The easiest way to remember them is this. Due to means I owe someone else. This is your payable. And due from means someone owes me. This is your receivable. From a financial statement perspective, due from accounts are the assets because money is expected to come back. Due to accounts are liabilities because repayment is owed. One reason auditors pay close attention to these accounts is that they help identify situations where one fund is effectively financing another fund. A due to, due from balance becomes a problem when no one knows where it comes from, why it exists, or whether it should still be on the books. In other words, the issue is usually not that the due to, due from balance exists. The issue is the lack of support behind the balance. So now we'll take a look at pooled cash. So many municipalities operate with one bank account that contains cash belonging to multiple funds. While there may only be one physical bank account, each fund still owns its own portion of that cash. So the bank account tells us how much cash exists overall, while the accounting records tell us which fund actually owns that cash. When one fund spends more cash than is currently available, a due to or due from relationship may be necessary to properly report the transaction and maintain accurate fund balances. All right, everyone, so let's take a look at the example on the right of the slide. This is where pooled cash creates confusion. The bank account is positive, but stormwater is actually in a deficit position. Without proper interfund accounting, management might incorrectly assume stormwater has cash available. This is why auditors spend so much time reviewing pooled cash reconciliations. Okay, so now we will look at a comparison between interfund transfers and due to, due from accounts. At a glance, both involve activity between funds. Money is moving. One fund is involved with another, and journal entries are required. However, the accounting treatment and financial statement impact is very important. So let's start with looking at interfund transfers. Interfund transfers are used when repayment is not expected. In other words, one fund is permanently providing resources to another fund. Because repayment is not expected, we do not create a receivable or payable. Instead, the transaction is recorded as a transfer out in the sending fund and a transfer in for the receiving fund. The transactions are typically reported on the statement of revenues, expenditures, and changes in the fund balance under the other financing sources and other financing uses. One important thing to remember is that transfers impact fund balance. The sending of funds available, resources decrease, while the receiving funds available, resources increase. The movement of resources is considered permanent. You will also notice several types of transfers listed at the bottom of this slide. So the first one we'll look at is operating transfers, which are used when one fund provides financial support to another fund as part of a normal operation. For example, the general fund may need to transfer money annually to support a recreation fund or a special revenue fund. Capital transfers are used to fund capital projects. A common example would be transferring resources from the general fund to capital projects fund to construct a building, to purchase equipment, or to complete major infrastructure improvements. So now we'll look at recurring transfers, which occur on a regular basis, such as monthly, quarterly, or annually. These are often included in the city's annual budget and happen consistently from year to year. Non-recurring transfers are one-time events. These may occur because of the special projects the city has, or an emergency situation, or another unique funding need that is not expected to occur again. Okay, so now let's compare that to a due to, due from activity. So due to and due from accounts are used when repayment is expected. Rather than permanently moving resources, one fund is temporarily covering costs or providing resources on behalf of another fund. In these situations, the paying fund records a due from account because it expects to be repaid. The receiving fund records a due to account because it owes the money back. Unlike transfers, these balances do appear on the balance sheet. Due from accounts are reported as interfund receivables, and due to accounts are reported as interfund payables. The difference is important because the financial statement impact is completely different. Transfers affect fund balance because resources are permanently moving between funds. Due to and due from activity affects the assets and liabilities because an obligation exists between the funds. So whenever you are unsure which accounting treatment to use when you are starting to put these entries together, one simple question is repayment expected? If repayment is expected, you are usually looking at due to, due from relationships. If repayment is not expected, then you're usually looking at a transfer. So if you remember that one simple rule, you will correctly classify most interfund transactions you encounter in local government accounting. All right, everyone, so let's look at some examples. The first example on the left is a transfer. The general fund transfers resources to a capital projects fund to support construction activities. Because repayment is not expected, the general fund records a transfer out, and the capital projects fund records a transfer in. You will not see a receivable or a payable because the transaction is permanent. Now, let's compare that to the example on the right, which represents a due to, due from relationship. In this scenario, the general fund pays payroll costs that actually belong to the stormwater fund. Because repayment is expected, the general fund records a due from balance and the stormwater fund will record a due to balance. The important difference is that the general fund now has an asset representing the amount it is expected to collect, while the stormwater fund has a liability representing the amount it owes. Once reimbursement occurs, both balances are cleared and the due to, due from relationship disappears. Okay, so let's look at another example and test our understanding. The airport fund paid a $10,000 insurance invoice that actually belongs to the sanitation fund. The accountant correctly recorded the expense and reduced cash, but there is a problem with this entry. I'll give everyone a few seconds to look at it. Okay, everyone, so what's missing? The missing piece is the interfund relationship. The entry records the expense, but does not establish that the sanitation fund owes the airport fund reimbursement. Without recording a due from in the airport fund and a due to in the sanitation fund, the financial statements do not accurately reflect who owes the money. This is one of the most important interfund mistakes that happen when you begin this. But the relationship of the fund is never established. Okay, so here you'll see what it looks like when it's correct. So because the airport fund paid the invoice, it records a due from sanitation fund. This represents the amount it expects to be reimbursed. The sanitation fund records the insurance expense because it received the benefit of that insurance coverage. It also records a due to airport fund because it owes reimbursement. Now, both funds are telling the same story, which is very important. The airport fund has an asset because it expects repayment. The sanitation fund has a liability because it owes repayment. Once these reimbursements occur, both balances will be cleared. This is the key difference between simply recording an expense and properly accounting for interfund activity. All right, everyone, so here is our last poll. So which part of the interfund accounting do you find most difficult? Is it accurately classifying between transfers and due to, due from, collecting and maintaining supporting documentation, reconciling interfund balances, presenting the financial statements properly, or an A? All right, and guys, remember, if you're having trouble responding to these polls, please email or answer in the Q&A with your answer and question. Okay, and it looks like most people have answered with accurately classifying between transfers and due to, due froms. It is not easy sometimes. Okay, so let's finish by talking about some of the most common mistakes we see with interfund accounting and some best practices for avoiding them. The first mistake is misclassifying transfers versus due to, due from activity. This is probably the most common issue we encounter. When the wrong treatment is used, it can affect fund balances, assets, liabilities, and ultimately the accuracy of the financial statements. The second mistake is netting interfund activity instead of reporting it gross. So in other words, some governments will only record the difference between the amounts owed rather than recording the full receivable and payable balances. This can make it difficult to understand what actually occurred and may create issues during audits or reconciliations. A third common issue is lack of supporting documentation. One of the first questions auditors ask is, why does this balance exist? If the answer requires searching through old emails, spreadsheets, or someone's memory, there is a good chance the documentation process needs improvement. Every interfund balance should have supporting documentation explaining how it originated and why it still exists. Another common mistake is improper financial statement presentation. For example, recording a transfer when a receivable or payable should exist, or leaving an old interfund balance on the books long after they should have been cleared. This can result, again, in assets, liabilities, revenues, expenditures, and fund balances being misstated. We also frequently see governments fail to reconcile interfund balances. A simple rule is that every due from should have a matching due to. If Fund A shows a due from balance of $25,000 and Fund B shows a due to balance of $25,000, if those balances do not agree, something is wrong and should be investigated. One additional mistake I see frequently is not recording interfund activity at all. So sometimes a fund pays an invoice on behalf of another fund and nobody records the due to, due from relationship, which is what we kind of saw in our previous example. This expense gets recorded, cash gets reduced, and then everyone just moves on. The problem is that the financial statements no longer tell the full story of who owes what. Okay, so now let's talk about some best practices. First, properly distinguish between transfers and receivables payables. Remember, the determining factor is whether repayment is expected. If repayment is expected, a due to, due from relationship should generally be established. If repayment is not expected, the transaction is usually a transfer. Second, establish clear policies and procedures. If everyone understands when to use transfers and when to use due to, due from accounts, there will be fewer inconsistencies throughout the year. Third, maintain supporting documentation in a centralized location. If someone asked where a balance comes from 6 months later, the answer should be easy to find. Fourth, ensure accurate financial statements reporting by reviewing interfund activity regularly rather than waiting until year end. Fifth, reconcile interfund activity monthly. This is one of the most effective controls a government can implement. Finding a problem during month-end close is much easier than finding it during audit fieldwork. Finally, properly account for interfund activity as soon as it occurs. The longer an interfund transaction sits unreconciled, the more difficult it becomes to determine what happened and who owes what. All right, so lastly, let's look at a good rule of thumb. So every due from should have a matching due to. Every balance should have a supporting documentation. Every interfund transaction should have a clear purpose. If those three things are true, your interfund accounting is usually in very good shape. All right, everyone. Thank you, and I'm going to hand it back to Yvette to talk about some key takeaways.
We're almost at the finish line. Thank you so much, Leo. So let's look at some key takeaways for today. As we wrap up today's session, I want to leave you with 4 key takeaways that you can immediately apply in your day-to-day work. First, journal entries are a simple way to tell the accounting system that something needs to be recorded, corrected, or adjusted. Whether you're fixing an error, recording an accrual, or classifying a transaction, journal entries help ensure the books accurately reflect what happened. Second, accurate journal entries are critical to maintaining financial accuracy, audit readiness, and clear reporting. A well-prepared journal entry not only keeps the general ledger accurate, but it also provides a clear audit trail for management, council members, auditors, and the public. Third, interfund accounting is essential in government accounting because we manage resources across multiple funds. Unlike private sector accounting, municipalities often have separate funds for different purposes. So it's important that the transactions are recorded in the correct fund and that the relationship between the funds are properly tracked. And finally, due to and due from accounts play a vital role in maintaining those relationships. When one fund pays on behalf of another or resources are temporarily shared, these accounts help us track what is owed and ensures that all funds remain balanced and accurately reported. So, if you remember anything else from today, remember this. Good journal entries create accurate records. Good interfund accounting creates accurate relationships between funds. Together, they create reliable financial statements and a smoother audit process. Thank you guys for your time and participation today. I hope that these concepts make your month end, your year end, and your audit prep process a little easier and a lot more effective. Now, I want you guys to please stand by for a word from my sponsors.
Thank you, Yvette. Thank you, Leo. So we do have a couple engagement opportunities coming up, 2 of which are this weekend. One, as Roger mentioned, the Georgia Municipal Association. Our team will be down there in Savannah. So if you're attending, we look forward to seeing you there. Roger and some other teammates will be at the GFOA conference in Chicago going into next week. And then there are 2 opportunities in South Carolina, Mass C in Greenville, and then the SCAC there at Wild Dunes, Isle of Palms at the end of July. So with that, that brings us to an end. We really appreciate all of you spending your time with us. We do know your time is valuable, and ultimately we hope that today made journal entries and interfund accounting a little bit more approachable. So here are some ways that you can stay in touch with us. We actively monitor that email address for our headquarters, phone number to reach any of us. One last reminder about the CPE credit. Please keep an eye out for that post presentation follow-up assessment. Completing that, along with being here for at least 50 minutes and answering the 3 polls, is what locks in your credit. So that is all we have. Thank you again for your time, and look forward to seeing you out there soon. Take care.